Advanced Financial Accounting Excel Practice Problem. In this presentation, we're going to work a practice problem related to interim income statement and tax calculation. Get ready to account with Advanced Financial Accounting. Here we are in Excel. We have our information on the left-hand side. We're going to put that into our worksheets on the right-hand side in the blue area. That's where the calculations will go. Our worksheet includes estimate of affected annual tax rate at the end of the second quarter. So we're looking at the second quarter, 3 months, second quarter that we'll be working with and focusing in on. We'll have to do an adjustment for the cost of goods sold. Then we'll take a look at the income statement for the 3 months ended June 30th because it's the second quarter. So income statement for the period, for that 3-month time period, second quarter we'll be taking a look at. Then in order to do that, we'll have to do a worksheet over here related to the tax calculation. Okay, so let's take a look at our information for the second quarter income statement. So we're going to be pulling our second quarter information. We had sales for the second quarter, 870,000, cost of goods sold, 440,000, operating expenses, 190,000. The quarter one, first quarter, income before taxes was 120,000. So income before taxes, first quarter, 120,000. The estimated effective annual tax rate for Q1, first quarter, we're looking into the second quarter. First quarter, we already worked these item out for the first quarter, 40%. Expected annual income of end of quarter two, at the end of the quarter two, the expected annual income. So now it's the end of the second quarter, and we're expecting what the annual income. We're going to annualize the income, and that's going to be 750,000. The dividend exclusion annualized, we're expecting as of the end of the second quarter, we're projecting 45,000. And then the tax credit that is anticipated will be 15,000 anticipated tax credit. Then we have the combined state and federal income tax rate that we assume as of the end of the second quarter. So the income tax rate, all income tax, federal and state, 50%. LIFO, we're going to be using LIFO inventory, so therefore we're going to have an adjustment related to LIFO, last in, first out. Cost of goods sold was 438,000. Inventory units, the base layer was 7,500. The base layer cost was 12. These units are expected to be replaced at a cost per unit of 26. So due to the fact that we're using last in, first out, we're going to have to make an adjustment for that, and we'll see that shortly. Okay, so let's go back on up to our worksheets up top, and we're going to be starting off with our estimate of affected annual tax rate at the end of the second quarter. So note what we have to do here. We have to kind of annualize everything for the books. Then we got to make any kind of tax adjustments that we have. Then we got to apply the rate that we think is going to be there for taxes for the taxable income. And then we need to account for any credits that are going to be involved in this. And then we want to take a look at the estimated affected annual tax rate, which is going to be a rate that we're going to then use to apply to basically the net income line. So let's take a look at this. We're going to say, all right, we got the income from operations is where we're going to start off here. And this is going to be the estimate that we have. We're estimating as of quarter two, but we're annualizing, thinking that the annual amount will then be 750,000. Then we're going to say we're expecting this dividend exclusion to happen. So this is going to be a difference between the tax and the books. So we're going to remove the dividend exclusion, and that's going to give us the estimated annual taxable income. So now we're going to have our taxable income. We'll sum this up, which will subtract them out. So the 750 minus the 45,000 gives us the 705. Then we're going to use the tax rate that we believe the tax rate is going to be applied to. Note that tax rate, of course, is applied to the taxable income. So the tax rate that we believe that's going to be applied to the taxable income is the 50%. That's going to give us the estimated annual tax before any credits that would be involved. If we multiply that out, which would be the 705 times the 50%, or the 352,000. Now we do have a tax credit that we do believe will be involved, and that's going to be for the 15. Let's make it a negative. We'll say negative, and we said there was a tax credit of 15,000. So that will give us the estimated income before taxes. So I'm going to add them up, I'm going to sum them up, which will subtract them out because that's the negative number. So the 352.5 minus the 15,000 is going to give us the 337.5, and then we have the estimated affected annual tax rate. So now we're going to give us our tax rate, and we're going to be dividing then. We'll take the estimated income taxes for the year, dividing it not by the taxable income, but by the top line, the income from continuing operations. So there we have our 45 now. So now the 45 is what we can then use for our calculations of the estimated taxes for the second quarter. Okay, so then we're going to go down. We got to do an adjustment for the cost of goods sold. Then we'll take a look at our income statement, and we'll have to do an adjustment for the tax calculation on the income statement as well. Now, the cost of goods sold is using LIFO, so we have a bit of an issue with LIFO because of, you know, the flow of the inventory that we're going to have with the last in, first out. So we're going to say, all right, here's the cost of goods sold. Cost of goods sold is that 438. But then we have a situation where we have the LIFO inventory liquidation situation. We're going to say that the expected cost per unit to replace is going to be $25 or $26, which we're getting from our data. These are expected to be replaced at a cost per unit of 26, and then the base year layer is currently at a per unit cost of 12. So the difference between those two, the change or the difference, is going to be equal to the 26 minus the 12. We're going to multiply that 14 difference times the number of units in the base year. Number of units in the base year being the 7,500. And that's going to give us our LIFO inventory liquidation. LIFO inventory liquidation, I'm going to be saying this equals the 7,500 times the 14 to bring us to that 105,000. So now we're going to have an adjustment for cost of goods sold, adjustment for the cost of goods sold that we're going to need here due to the LIFO inventory liquidation is going to be equal to the, or we can just sum it up. I can add them up, but I'll just sum up the whole thing. Summing up or just adding these two. Now I forgot the equal sign. Summing up these two. Okay, so there we have that. So there's the 543. So now we can use that adjusted cost of goods sold in our income statement calculation. So let's take a look at our income statement. We'll have to stop for taxes, but let's see what we have so far on the income statement. So we're going to say we got sales are going to be equal to the sales number they gave us, the 870. So it is what it is. For the second quarter, this is for the second quarter ended for the 3 months ended, for 3 months ended June 30th. Then we're going to say our cost of goods sold. We're going to adjust that for our LIFO inventory liquidation, which we did up top. That's going to give us, of course, our gross profit as we subtract that out. So we'll do our gross profit equals the 870,000 minus the 543,000 gives us the 327,000. Then we have our operating expenses, which are provided for us. The operating expenses given at the 440,000. 440,000 for the that's not it. It's 190,000. Sorry about that. 190,000 for the operating expenses given to us in the problem. And then we're going to have our income before taxes then. Calculation, income before taxes, which is going to be equal to the 327,000 minus the 190,000 to give us the 137,000. Then we're going to have to do our taxes on it. So now we have our taxes, which you would think we could just take that 137,000 times the 45% estimated effective annual tax rate that we just calculated up here. But we can't really do that because we had an estimate in quarter one too. So we're going to have to make an adjustment for the estimate we made in quarter one as we go forward. So for that, we're going to go do our worksheet up top. So we got the income before taxes and then the tax and benefit over here. So we got the interim period 1, first quarter here. In the first quarter, we had the 120 quarter 1 income before taxes. And then we had the amount year to date is going to be the same amount. The tax then, the estimated effective annual tax rate was at that time 40%. That's what we estimated, we did this little calculation over here for Q1 for the first quarter, and we came up to 40% instead of the 45 that we have now. So then we said that the tax then was equal to the 120,000 times the 40%, or 48,000, less previously provided. Nothing is there, so this is just going to equal this 48,000 reported in the period 1. So now it's period 2, and we're saying that that we have the income now of the 137,000 before taxes that we just calculated down here. So year to date then is going to be equaling the first quarter, the 120 that we had like for the first 3 months, plus the 137 for the current 3 months, the second quarter. And now we're saying now we've got better information because it's later, and we think that our calculation here for the estimated effective annual tax rate is now 45% instead of 40% because we did this calculation down here. We think it's 45%. So now if we multiply that out, if we take the year-to-date revenue, first and second quarter, times that 45%, we get 115,650. But we can't really, we use that number because we already used 45,000 for the 40%, you know, in the first quarter. So we're gonna have to say, all right, we'll have to subtract out the first quarter. So I could say like negative of this number, and then we'll subtract this out, equals the sum then of this plus this, or that'll subtract it out. So 115,650 minus the 48,000 gives us the 67,650. So that's what we're going to have in the second quarter. So in other words, we're looking on the income statement now, right? We're going to say, well, as of the second quarter calculation, we're saying 45% is the estimated effective annual tax rate. We're going to multiply that times the income year to date at this point in time, first and second quarter. So times the 45%, that means we should have tax, you know, reported in first and second quarters of 115,650. And then we're going to take into consideration what we already reported in the first quarter, which was 48,000 based on an estimate of 40% tax rate. And the difference then, the 67,650, is what we're going to have to report then in Q2. So you can see how this estimate kind of rolls forward as we make these estimates. So now we can pull that number down to our income tax down here. This is going to be equal to the 67,650, and then we're going to have then the net income on the bottom line. Bottom line net income equals the income before taxes minus the income taxes of the 67,650. So obviously this number is one of our key calculations to consider as you kind of work forward. You gotta come up with this number here. Then we gotta basically figure this thing as it rolls forward and make adjustments each quarter to make the proper adjustments to what will be reported in the current period, the current interim period income statement.